Ever confidently hit that buy button, certain you'd outsmarted everyone, only to watch your pick tank?
Happens to the best of us.
I'm still haunted by my Enron experience. Turns out, experience doesn't make you immune to market mirages. So how do we avoid those pitfalls and actually gain an edge?
It's less about outsmarting the market and more about understanding it. It's about recognizing the rhythm, the patterns that emerge from specific events, like mergers, for instance.
Okay, so when one company gobbles up another, what kind of patterns are we talking about?
Well, it rarely happens at the exact share price offered, right?
Yep.
There's that gap between expectation and reality.
And that's where the opportunity is. Sounds a little like tightrope walking.
More like calculated risk. Let's say Microsoft and Activision Blizzard, remember?
Big acquisition, lots of buzz.
Right, but remember the regulatory concerns. Activision's stock was trading lower than Microsoft's offer because of that uncertainty. Created a nice little spread.
Spread being?
The difference between the discounted price and what that acquisition price could be. Essentially, the potential profit if the deal goes through.
Okay, so it's not just about spotting a potential merger, but analyzing how likely it is to actually happen. What happens if the deal falls apart?
Ah, the risk.
Yeah.
The dreaded busted deal. The Rite Aid and Albertsons situation comes to mind. Regulatory hurdles derailed the whole thing. Those on the wrong side of that trade, well,
Let's just say they learned that lesson the hard way. But mergers are just one piece of this puzzle, right? The book also dives into stock buybacks, which, frankly, have always seemed a bit counterintuitive. Why would a company buy back its own stock?
it's essentially a company signaling, hey, we think our stock is undervalued, putting their money where their mouth is, hoping to boost the share price.
So bullish signal, time to jump on board.
Not so fast. Remember Bed Bath & Beyond?
Oof, yeah.
Their aggressive buyback strategy happened right alongside, well, a few other challenges.
So, buybacks, a signal, but not always one you can hang your hat on. It's like they were trying to bail out a sinking ship with a teaspoon. What else do we need in our arsenal to navigate this event-driven landscape?
Let's talk SPACs, those special purpose acquisition companies that seem to just take the market by storm.
SPACs, right. Blank check companies, some call them. Wall Street's flavor of the month?
Essentially a shell company, no real business operations to speak of, going public with the goal of merging with a private company.
So a backdoor to going public. Why not just go the traditional IPO route?
Speed and cost, for starters. SPACs can be quicker, potentially less expensive than the traditional IPO route.
Yeah,
It's appealing to some companies for those reasons.
but faster isn't always better, right? WeWork's SPAC merger, that didn't exactly rewrite the playbook.
No, it didn't, which is why due diligence is so crucial in the SPAC world. Look beyond the hype. Scrutinize the SPAC's management team, their track record, their experience in the target company's industry, and of course, dissect the financials of the company being acquired, just like you would with any investment.
So it's not just about betting on a SPAC, but on the jockey and the horse they're backing, so to speak. All right, what about spinoffs? We touched on Ferrari's success, but how can investors spot these potential breakouts before they become the next big thing?
Spinoffs are interesting because they're often about unlocking value. A division that might be holding a parent company back, or maybe it's just misunderstood by the market. A spinoff gives it the chance to stand on its own 2 feet.
So it's about recognizing those diamond-in-the-rough situations before everyone else catches on. What separates a potential winner from, well, another cautionary tale?
It's about understanding the why behind the spinoff. Is the parent company trying to unload a struggling division, or are they unleashing a high-growth, high-potential business? Look at that, for one.
Motive matters. Got it. What else?
Insider buying, always a good sign. Insiders putting their money where their mouth is, that shows confidence. Also, pay attention to the debt structure. Sometimes parent companies will saddle spinoffs with debt, which can hinder their growth potential.
Right, like sending your star player to a new team, but making them carry all the equipment, not exactly setting them up for success. Okay, so we've covered SPACs, spinoffs. Let's shift gears to something a little less, well, structural and a bit more human. Management changes. How can these impact a company's trajectory?
Management changes are like wild cards. A new CEO can be a breath of fresh air, fresh ideas, shaking things up, driving growth. On the other hand, a poorly chosen leader, well, that can spell trouble.
It's like that old saying, a fish rots from the head down. A bad CEO can really poison the well. How do we evaluate whether a leadership change is a reason to buy or sell?
Track record, that's key. Look at what they've accomplished before, what they're known for. Are they an innovator, a turnaround specialist, someone who brings stability? Also, look their vision for the company. Does it align with your investment thesis?
Like evaluating a new coach for your favorite sports team. You want to see a history of winning and a game plan that makes sense. Okay, let's bring back insider buying for one last analysis. We've talked about it a bit, but it's always good to dig a little deeper. It's often seen as a major market signal, but we know it's not always a sure thing. How can we accurately interpret those insider moves?
Insider buying is definitely a positive sign, but context is key. Remember, insiders might sell for any number of reasons. Diversifying their portfolio, maybe they're buying a house, you name it. But they usually only buy for one reason. They think the stock is going up.
So it's not just about seeing one insider buying a few shares, it's about looking for a pattern of larger purchases, ideally by multiple insiders.
Exactly. Look for those clusters of buying, especially after a dip in the stock price or when the company's undergoing some kind of major transformation. That's when insider buying can be the most telling.
It's like they're putting their money where their mouth is, but in a way that speaks volumes. It's like getting a sneak peek at their playbook, but with real money on the line.
Okay, we've done a deep dive into mergers, buybacks, even learned how to read between the lines on insider trading. But there's still a few more tools in the event-driven investor's toolkit, right? Let's unpack SPACs a bit further. They've gotten a lot of buzz, to say the least. Blank check companies. Wall Street's hottest trend, even. What's the real story?
Well, think of a SPAC as a shell company going public with a pile of cash and a singular purpose, their mission. Find a private company and merge with them. Basically, take that company public.
A shortcut to an IPO, with the added pressure of a ticking clock, right? Because SPACs typically have a limited time frame to make a deal.
Exactly. And that ticking clock can be appealing for both sides. The private company gets access to public markets faster, potentially cheaper than a traditional IPO. But as we've touched on, faster doesn't always mean better. WeWork's SPAC journey, that's a prime example.
So how do you tell the WeWorks from potential winners in the SPAC space? Do due diligence. Due diligence. Due diligence. That's the name of the game. Look beyond the hype and scrutinize that SPAC's management team. What's their track record? Do they have experience in the target company's industry? And of course, you've got to dissect the financials of the company being acquired, just like you would with any other investment.
So it's not just about betting on a SPAC itself, but on the people calling the shots and the company they're bringing to the table. Okay, let's move on to spinoffs. We've talked about Ferrari's success, but for everyday investors, how can we identify these potential breakouts before they become the next hot stock tip?
Spinoffs are fascinating because they're often about unlocking hidden value, Sometimes a division of a company is holding the parent company back, or maybe the market just doesn't quite understand it yet. A spinoff, it gives that division the chance to really shine on its own.
Like that classic superhero movie trope where the sidekick realizes, hey, I can be the hero of my own story.
Exactly. And just like in those movies, there are signs, there are clues to watch out for. First and foremost, you want to understand the why behind the spinoff. Is the parent company, are they just trying to dump a struggling division? Or are they genuinely unleashing a high-growth, high-potential business?
Motive matters. Wait it. What else should be on our spinoff checklist?
Well, as we've discussed, insider buying is always a good sign. Those in the know, if they're putting their own money into the spinoff, well, that tells you something. Another thing to look at is the debt structure. Sometimes parent companies will actually saddle spinoffs with a load of debt, and that can really hinder their growth potential.
It's like sending your star player to a new team but making them carry all the equipment. You're not really setting them up for success. All right, we've tackled SPACs, we've explored spinoffs. Let's shift gears to something a little less structural and a bit more, well, human. Management changes. How can those shake up a company's trajectory, for better or for worse?
Oh, management changes. Those are like wild cards,
Yeah.
A new CEO, it can be a real breath of fresh air. Fresh ideas, shaking up the status quo, really driving growth. But then again, a poorly chosen leader, well, that can spell trouble.
It's like that saying, a fish rots from the head down. A bad CEO can really poison the well, so to speak. So how do we evaluate whether a leadership change is a reason to buy into a company or sell our shares as fast as we can?
I'd start by looking at their track record. What have they accomplished at previous companies? Do they have a reputation for, say, innovation? Cost-cutting. Maybe they're known for turning around struggling businesses. You want to know what you're getting. And then look at their vision for the company.
Yeah.
Does it align with your investment thesis? Does it make sense to you?
It's like evaluating a new coach for your favorite sports team. You want to see a history of winning and a game plan that gets you excited. Well, listeners, this deep dive has been a masterclass in event-driven investing. We've gone from mergers and buybacks to those buzzy SPACs and spinoffs. We've even learned how to decipher the language of insider transactions. But beyond the mechanics, I think the real takeaway is that it's about thinking differently, about spotting opportunities that others might miss.
It's about being proactive, not reactive. Instead of following the herd, event-driven investing, it empowers you to anticipate those market-moving moments and position yourself for success.
It's about turning those what-if moments into what-if-I-had opportunities.
Yeah.
But as we've discussed, it's not a guaranteed path to riches, right? It requires careful analysis, a healthy dose of skepticism, and a willingness to embrace the unknown. So the next time you see a headline, maybe it's about a merger, a spin-off, even a CEO shakeup, remember what we've talked about today. Don't just read the news, analyze it, question it. And who knows, you might just uncover your own event-driven edge. This is The Deep Dive. Signing off.